Good afternoon, everyone. Today I'll be presenting my financial analysis of the Coca-Cola Company's 2024 Statement of Cash Flows. The purpose of this review is to assess Coca-Cola's major sources and uses of cash, and to evaluate the company's financial strengths and weaknesses based solely on its cash flow performance. My sources include Coca-Cola's 2024 Form 10-K filed with the U.S. Securities and Exchange Commission and Young's Corporate Financial Textbook for Analytical Framework. Coca-Cola prepares its statement of cash flows using the indirect method, which starts with net income and adjusts for non-cash items and working capital changes. The statement is divided into three key sections: operating, investing, and financial activities. According to Young, analyzing these categories helps managers understand whether cash is being generated from the company's core operations, asset investments, or external financing. In 2024, Coca-Cola generated $6.8 billion in cash from operating activities. The main sources of cash included $1.1 billion in depreciation and amortization, and roughly $4 billion in other operating charges, both non-cash items added back to the net income. The major uses of cash were a $6.2 billion decrease in operating assets and liabilities, and a $1.7 billion reduction from significant gains. These working capital outflows and gains lowered operating cash flow even though they boosted net income on paper. Coca-Cola reported $2.5 billion in net cash provided by investing activities in 2024. This positive cash flow was primarily driven by $6.6 billion in proceeds from investment disposals and $3.5 billion from business divestitures. The main uses of cash were $5.6 billion for new investments and $2.1 billion in capital expenditures for property and equipment. Overall, Coca-Cola effectively offset capital spending with strategic asset sales, providing liquidity for other needs. Coca-Cola used $6.9 billion in cash for financing activities during 2024. The company raised $12.1 billion from new debt insurances and $747 million from stock insurances, demonstrating continued access to capital markets. However, it spent $9.5 billion repaying debt, $8.4 billion on dividends, and $1.8 billion repurchasing shares. These cash outflows indicate that Coca-Cola prioritizes shareholder returns and balance sheet management, even while maintaining moderate leverage. Coca-Cola reported net income of $10.6 billion, but only $6.8 billion in operating cash flow. The differences arises from several non-cash adjustments. Depreciation and amortization added $1.1 billion, other operating charges added $4 billion, but working capital changes and gains deducted more than $8 billion combined. According to the MD&A, the largest single factor was a $6 billion IRS tax litigation deposit, which temporarily reduced operating cash flow. This example illustrates Young's point that reported earnings don't equal available cash. Non-cash and timing adjustments are essential for accurate liquidity assessment. Coca-Cola's key strength is its consistent operating cash generation. Even after a $6 billion one-time deposit, it produced a positive $6.8 billion in operating cash. The company's free cash flow, after subtracting capital expenditures, totaled roughly $4.7 billion, enough to sustain dividends. Coca-Cola also maintains ample financing flexibility, issuing over $12 billion in new debt and realizing positive investing cash flow through strategic deposits. These factors indicate a resilient cash structure and strong liquidity position that support continued operational success. Weaknesses include large working capital outflows of $6.2 billion, heavy cash distributions to shareholders exceeding free cash flow, and volatility caused by one-time items like the IRS deposit. If these outflows persist, Coca-Cola could face pressure to rely more heavily on external financing for dividends and buybacks. In conclusion, Coca-Cola's cash flow statement shows a well-managed but capital-intensive business with strong fundamentals. Its operating cash flow remains healthy, but sustainability will depend on stabilizing working capital movements and moderating shareholder payouts.